Yeah, I gotta take these two classes. Because if I don't, there'll be double work for me to do. Unbelievable.
Good afternoon, everyone. My apologies. For some reason, I couldn't find the thingy, the link. And now, if I can just get the school to enable me to share my screen, we can begin. Let's see if I can send them a text. There we are. Okay. All right, folks. Oh, there is, let's see. Crystal, Lake, Miguel, Sanchez. Okay, we're good to go. All right, ladies and gentlemen, let's see if we can wrap things up this evening. We want to conclude our discussion this semester by focusing some attention on the central bank. All right. Hopefully, we won't go very long. And at the end, I want to talk a little bit about what I'm looking to do on Monday, and you guys can tell me if you are okay with it. Okay, so let's start with the central bank and how they fit into this whole monetary system. So to begin with, the central bank is governed by legislation. The original Central Bank Act was written in passed in 1974, July to be exact, and almost exactly a year after the Bahamas independence. That act existed until 2000, when it was repealed and a new act was written in its entirety to replace that original act. The impetus at the time had a lot to do with the blacklisting of the Bahamas, which we'll talk more about in a second. And then 2 years ago, that 2000 Act was repealed and replaced in its entirety by a new Central Bank Act 2020. Right? And one of the reasons behind a lot of this is really to allow central bank to expand its role, to develop its role, to evolve in what it can do. There are two types of legislation that is passed in the Bahamas and most countries. Right? One type is similar to our criminal statutes. And our criminal statute says that it identifies everything that is considered a crime. And the way the law works, then, if it's not identified in the statute as being illegal, then technically it's legal. Right? So this type of legislation identifies what you can't do, and anything that it doesn't mention, you're allowed to do. Then you have legislation similar to the Central Bank Act, which is just the opposite. These type of legislation, and almost all central banks have this type of legislation, where the legislation tells the institution that you can do this and only this. And if it's not specified in the act, you can't do it. Right? So you have some type of legislation that says, yeah, I'm going to tell you what you can't do, and anything I tell you can't do automatically means you can do it. And then you have this type of legislation that says, this is all you can do. And if it's not mentioned in the act, you can't do it. Which means then that if there's an identified need that the central bank can satisfy, in fact, the legislation have to be adjusted, changed, amended, or repealed to allow new legislation to put in place to enable the central bank to perform that specific function. Right? This works in general, but sometimes it does cause some issues, particularly when this is not understood as well as it could be by the general public. So one example would be the issue of bank fees. There is always a hullabaloo and a hue and a cry for central bank to do something about bank fees, control bank fees, stop banks from imposing additional fees, make banks roll back fees, make banks justify those fees. None of that the central bank is able to do because it's not in the central bank legislation. There's nothing in the Central Bank Act 2020 that gives the central bank the authority to act in any way as regards to bank fees. Now, this is not an unknown thing by various political administrations in the Bahamas. They've known this from 1974, right? But at no time, and we see not in the 1974 Act, not in the 2000 Act, not in the 2020 Act, did any government decide to put into that act giving central bank the right, the authority to act on bank fees. Right. Some central bank actually do have that mandate. Our central bank doesn't, and no administration has put it into the act. Right. But that's just one example where you have an institution that cannot do what is not in its act. And the legislation is written in this way for a very specific reason. Right. What you don't want as a government, as a people, you don't want an institution like the central bank with its integrity, its money, its reputation, and most specifically, a ton of smart people sitting in the institution. You don't want to allow that institution to follow its own course without some kind of control, some kind of constraint, right? That is probably not the best thing at all for any government, and the central bank itself probably doesn't want that either, right? Because what it means is that you end up with something that's called mission creep, which means that you have an institution that's taking on more and more responsibilities and roles, even when it's outside of their core function. Right? So the legislation acts to try and curtail the ability of a central bank to expand beyond its mandate. Okay. That being said, let's continue. What exactly are the functions and the origins and functions and objectives of the Central Bank of the Bahamas as a prototypical central bank? Because our central bank is not terribly different from central banks all over the world. Right. So if I'm quoting from the Act, it is the duty of the bank to promote and maintain monetary stability and credit and balance of payments conditions conducive to the orderly development of the economy, to promote and maintain adequate banking systems and high standard of conduct and management therein, and to advise the Minister of Finance in any matter of financial or monetary nature. Right? So monetary stability, credit and balance of payments conditions to conducive to orderly development of the economy, maintain and promote adequate banking system, and provide advice when called upon. Right? That in a nutshell is the function of the central bank. But more specifically, the central bank regulations, which comes out of the Act, is much broader. The Act itself is less than 20 pages. The regulations are several hundred pages. All right. The regulations for any institution or industry operationalizes the legislation. All right. You would have noted that I had starred the Central Bank Act 2000, and the reason why that is so is because that act was a very specific reaction to a situation where the Bahamas found itself in 2000. That is what we historically have called the blacklisting. Quick historical recap. In June 2000, there were three global international financial institutions and agencies, bodies, that have identified the Bahamas among a number of jurisdictions that they had significant issues with. Right? There was the Organization for Economic Development and Cooperation, OECD, which is a European organization. It's based in Paris, and their principal concern is that they want to make sure that when their citizens make money, earn money, their citizens pay taxes that is due to them. So they're concerned about tax compliance, right? Their concern is that you have these rich people in Europe decide that they're going to ship their money away to all of these tropical island destinations and don't pay tax at home. So they want to ensure that somehow these jurisdictions provide them, the OECD, with information about people who have bank accounts and whatever in their jurisdictions, so that they can go after these people to make sure that they've paid appropriate taxes at home. Right? So they want countries like the Bahamas to go through their list of people, making sure which country they're from, and then how much money they have stashed in the Bahamas, and send that information back to the OECD so that they can share that with their tax authorities in Europe, and then the tax authorities can then tell these people, okay, you need to make sure that you paid all your taxes. So in essence, they're asking the international centers, what we used to call the offshore centers, to act as their policemen. And then you have the Financial Action Task Force, which is the FATF. They are an agency of the OECD, but their concern is money laundering. Their concern is to make sure that jurisdictions around the world, particularly international financial centers, are not being used to launder illicit funds. And finally, the Financial Stability Forum, the FSF, which is an agency of the Bank for International Settlements, the BIS, in Basel, Switzerland. The BIS is the central bank's central bank, if you will. All right. And the Financial Stability Forum, as an agency of the BIS, is concerned with making sure that regulators properly supervise their licensees. So they want to make sure that central banks and other regulatory agencies are properly supervising banks in their jurisdictions. So these three agencies, international bodies together, individually and collectively, identified the Bahamas, along with 35 other jurisdictions that they said weren't holding up their end, that they were deficient in regard to these specific areas of concern. Right? Some were saying, well, you're not doing an adequate job. Some are saying you're deliberately hindering our effort to collect taxes from our people. But whatever it is, these three bodies compiled a list of jurisdictions and published that list, the name and shame list, and that list was called the blacklist. And the Bahamas was one of those identified on that list. But these agencies and the governments behind these agencies went one step further. They said, listen, y'all need to shape up and take steps to comply with what we said y'all need to comply with, else we will take steps to shut you off from the global financial system altogether. Right? That is, as a country, you would not be able to engage in any financial transactions across borders or outside of your borders. Right? As you may imagine, this is a death knell for a country like the Bahamas. Right? So it's not just financial transactions. That means that we cannot, we would not be able to engage in international trade, because how are you going to convert that US dollars to Bahamian dollars? I don't know. Right? So it became a major issue for the Bahamas, and something that we needed to address post haste. Right? And despite the fact that we had a lot of issues, and similar jurisdictions who identified like us had issues with the fairness of a lot of these things, and how the requirements that were being imposed on us by agencies like the OECD were not being required of countries in Europe. So they were putting these on these onerous conditions on a lot of these international status, small places like the Bahamas, that they weren't willing to impose on themselves. But since they're big and rich and powerful, they get to call the shots. In response, the central bank, along with the entire financial services sector and the government, so both public and private sector, got together, spearheaded by Central Bank and Ministry of Finance, to try and address these issues. And they passed a whole suite of legislation trying to cover as many of these issues as possible. So we end up with a new Central Bank Act in its total. The previous Bank and Trust Company Regulations Act was repealed, and a new Bank and Trust Company Regulations Act was written. Both the Central Bank Act, the new Central Bank Act, gave the central bank enormous new powers to regulate and supervise and if necessary, shut down banks. The Bank and Trust Company Regulations Act, the new act, placed additional responsibilities on banks and trust companies operating in the Bahamas, both in terms of governing their own activities and the activities of their clients, but as well as sort of formalizing a lot of the reporting arrangements between themselves and the regulator, being the central bank. A new act was written called the Financial Intelligence Unit Act, which created the Financial Intelligence Unit. The FIU is, in essence, the policeman for the financial services sector. They're staffed with persons with accounting and finance background, but also who are licensed law enforcement individuals. So if there is an issue with a specific bank, let's say there's a money laundering issue, right? The FIU will deal with the specific bank customer as a criminal matter, while the central bank will deal with the institution itself and police the institution itself. That way, both the institution and the individual may be sanctioned for contravening any of the, in this case, money laundering legislation. A new act was written, the previous Proceeds of Crimes Act was repealed, and a new act was written giving both the central bank and the FIU authority to confiscate criminal proceeds. In particular, included in this act allowed the central bank to acquire financial resources from criminal activities. So if you were found that you had stashed illegally tons of money in some obscure bank license in the Bahamas, you could find that that money has been confiscated by the central bank, and you would have to prove to the bank that, in fact, this money is legitimate, how you got it, where you got it from, et cetera, et cetera, et cetera. All right. Financial Cooperative Service Providers Act. What this act did is that there are a number of industries who have only indirect association with the financial services sector, but important associations nevertheless. So, for example, this addresses things like accounting firms, law firms, and when those entities interact with the financial services sector, either directly or through their clients, it provided certain responsibilities that these entities have. Then you have the Financial Transactions Reporting Act, again, placed responsibility on both banks and non-bank entities to report suspicious transactions. Banks now had to create what is called suspicious transactions reports, which are filled out depending on the institution, whether we're talking weekly, daily, weekly, monthly, or quarterly. And you would report to the central bank if, in fact, transactions meet certain criteria that are identified in the Financial Transactions Reporting Act. This act also applied to non-bank financial entities like casinos, which had never been brought under anybody's jurisdiction except the casino licensing board, the gaming board. But now, because it was found that casinos seem to be an ideal place for money laundering, right? You go into casino, well, not payments, but this was before, gaming houses went legal. You have a lot of non-Bahamian go into a casino, and you have tons of illegal cash on you. You play a couple of games, you act like you lose some money, and then you buy tons of chips with your illegal cash, play a few games, then go back to the cashier to cash in your chips and said, you know what, instead of giving me cash, give me a check so that I am much more comfortable with a check as opposed to walking around with this cash. Now I have a perfectly legitimate check that I can deposit in any bank anywhere in the world, and it's now nice and clean money laundering at its finest. So now casinos are required to report some of these transactions if they meet certain criteria that would fall under suspicious transactions coming out of the Financial Transactions Reporting Act. The IBC Act 2000 replaced the previous National Business Companies Act and gave the central bank enormous power over a lot of these sort of businesses that are registered with the Registrar General's office, but were used for purposes other than what would they identify as. So it gave the central bank and then later the Securities Commission authority to investigate and criminalize a lot of these transactions, and in fact shut down a lot of IBCs that previously existed in the Bahamas. And we go on, all right? But the idea is that we had a ton of new legislation coming about. Previous legislation was repealed and replaced, all in an attempt to address these concerns and alleviate the concerns of these agencies, regardless of how unfair we thought they were. We just could not risk the likely outcome if we did not comply. It still rankled. It rankled every administration, every government administration I'm aware of, and every minister of finance that I'm aware of. But, all right, what did the central bank in fact do? All right, coming out of the in response to the blacklisting, the new act, Central Bank Act, did a couple of things. It forced the central bank to more than quadruple the size of its bank supervision department, right? And to the point now where the bank supervision department of the central bank is a building in and of itself, all right? It created new units within the bank with specific focus on things like money laundering and that kind of thing, proceeds of crime, et cetera, et cetera. The bank now enhanced both its on-site and off-site inspection protocols. On-site means that the bank has a team of inspectors that go in actually to the banks themselves, head office, and then individual branches, and has a whole tray load of things that they need to go through and look at. For example, they may say, I want to see records of every credit that you issued above $10,000. We want to see who it went to, what was the collateral, what was the procedures involved in approving this facility, et cetera, and that's just there. And that would apply to all the businesses that an individual institution may be involved in. And then they have a whole series of protocols in terms of they would be sitting in the bank's head office and they're looking at the bank's governance procedures, right? How do you, as the managing director of the bank, et cetera, the highest level of the bank, how do you manage the institution down to, you know, the last person who walked through the door? In addition, there was an increase in the frequency of these inspections. It used to go every 2 years to now it has to be annually, unless there's a good reason for it not to be. There used to be a number of banks licensed in the Bahamas who really, they just had their name in an accounting office or a law office, but they did not actually have what we call a physical presence, right? The act now gave central bank the authority to require physical presence for all banks licensed in the Bahamas. A physical presence means that you have to have offices, you have to have officers, all right? You have to have records all located in the Bahamas and available for review and an inspection by central bank inspectors, right? The act also gave central bank authority to enhance home and host country cross supervision, right? So it means that, let's say you have Swiss Bank Corp has a subsidiary in the Bahamas. So the Bahamas, as the host country, would have some supervisory responsibility for that entity. But Swiss Bank Corp is a subsidiary of its parent company located in Geneva. All right. So in that case, Geneva is the home country for Swiss Bank Corp. So the Swiss regulators and Central Bank of the Bahamas would now have the ability to communicate and cooperate to make sure that the entity operating in the Bahamas is properly supervised, that there's no shenanigans where the head office is stashing some money in the local office here to avoid scrutiny in Switzerland or vice versa. Right. It also gave central bank enormous power to significantly increase fines for non-compliance. Right. You're required to report to central bank on a daily, weekly, monthly, quarterly basis on all your activities, and you know, and not just report, but report on time. And you are responsible for making sure all your I's are dotted and T's are crossed. Now the central bank is in a position where not only are they not prepared to give you any leeway for anything being late or incomplete or whatever, and the central bank can now begin imposing significant fines, you know, to the point where we've had instances where the bank has imposed a sign to say a fine of $5,000 on a bank per day for every day that the report that the bank is requiring of them is late. Let's say you're a month late, that's $150,000. That kind of thing adds up very, very quickly, and it really concentrates the minds of the licensees. And also the central bank then undertook a broad-based review of every bank licensed in the Bahamas, whether you're talking about commercial bank or offshore international bank, and took a very long, deep look at the senior management, the senior persons in those institutions, and did substantive background checks, both here and abroad, with wherever the person said they originate from, connected with people like the FBI in the United States, the Royal Canadian Mounted Police in Canada, the Swiss Guard in Switzerland, Interpol in Europe, just to make sure that, listen, the people operating these institutions in the Bahamas are unlikely to be involved in the kind of things that has raised concerns. Right. And then this is just a partial list of a whole list of things that have come out of the Act that has changed the way central bank approaches the regulation and supervision of its institutions. I thought it would be important for us to get that background when we begin talking about what actually the objective and functions of our central bank, like most central banks. So what is its objectives? The objectives, and I have a list, firstly, to safeguard the external value of the Bahamian dollar, which is fixed at 1-to-1 parity with the United States. I put this first because this is above every other regulation, function, or objective. This is job one. Above anything else, it's written in the Central Bank Act that the central bank is responsible to make sure that the Bahamian dollar stays fixed at 1-to-1 parity with the United States dollar regardless. So the central bank will do anything and everything in its power to make sure that this stays fixed at 1-to-1. There have been occasions in the Bahamas where the central bank's responsibility in this regard has clashed with what administrations are doing. Right. So if you have a government, for whatever reason, is running up a very large foreign currency debt, right? They borrow a lot in foreign currency, or they're acting in such a way as to reduce the likelihood we have US dollars coming into the Bahamas, right? If you go back historically, think of the last administration of under the Pinley government, where there was a lot of concern about corruption and criminality and Colombians having Norman's Key and Carlos Leader and these big time drug guys owning islands in the Bahamas and owning Bahamian politicians. In fact, there's this famous article, I think it's in the London Times, called Country for Sale, talking about the Bahamas, and it led to, commissions of inquiry, et cetera, right? When you have situations where an administration in its actions, the fiscal authorities in its actions are likely to affect the value of the Bahamian dollar, this 1-to-1 parity, the central bank can act and does act, even if it means going against the government of the day, right? This is one of the reasons why although the central bank technically comes under the Ministry of Finance, the central bank has what is called operational independence. That is, the government can write the legislation, and you can say in the legislation, the central bank is responsible for maintaining the Bahamian dollar fixed at 1-to-1. What the government does not do and cannot do is tell the central bank how to do this. You can tell the central bank what to do, but not necessarily how to do. Right? And so you have a case where the central bank will act in a way that may be not unpopular from a political perspective, but it serves the purpose of maintaining the fixed exchange rate parity. Right. Objective. Administered exchange control regulations. Again, this comes back to trying to maintain the Bahamian dollar fixed at 1-to-1. Right. As a Bahamian, you know, as well as you know your name, that whenever you need to travel or do anything, you need US dollars, you can get it. And the Bahamian dollar first became the Bahamian dollar in 1966, was when we first got the Bahamian dollar and we left the pound. So from 1966 to now, there's never been a time in our history where Bahamians really feared that they could not get US dollars when they needed it. Even now, in worst comes to worst, you can go into a commercial bank with your passport and say, I want to buy US dollars, and they will charge you $5 for every 1,000, right? Which is 0.05%, right? Or 5 cents for every 100, same thing, right? And in fact, what has happened now for Bahamians in general, we don't even go through that issue anymore. We don't need to find somebody, some straw vendor or taxi driver US dollars. We don't even need to go to the bank. What we do is that when we jump off the plane, wherever we're going, first thing we do, walk up to the nearest ATM, put in our debit card, and we withdraw US cash. Because we know somewhere along the line, we don't understand how, and it doesn't really matter to us how, we know that that money is going to come off our Bahamian dollar bank account, and it's going to be converted at some place to US dollars, and we can withdraw it off through any ATM, for example, in the United States. Right? And that can only happen because the central bank has one of its objectives to maintain the country's external reserve. That is to make sure that there's always enough US dollars available for Bahamian individuals, companies, or the Bahamian government whenever they need US dollars. All right. The central bank exists to make sure that there's always sufficient US dollars. And because that's been the case for so long, we don't think about it anymore. All right. And if you've ever traveled through the rest of the region, particularly, you will realize how unusual that is. All right. Because people hoard US dollars because they don't know when they're going to be able to get more. All right. So you hang on to it knowing that, listen, I have a trip plan at some point, and so this is what I need to do to make sure that I have sufficient US dollars for things I need to do. We Bahamians don't think like that because all of our lives, that's never been an issue. Somehow, we have grown up believing to our very core that little old Bahamas, with what, 400,000 people, right? And an economy that's maybe 10 billion, 11 billion, 12 billion, depending on who you're talking to. Somehow, our currency is just as valuable as our big neighbor next door, the richest country on the planet. And we don't think anything strange about it. We're absolutely certain and believe to our core that our one Bahamian dollar should be equal to one US dollar. Because that's the way it's always been. So why should it change? All right. Central bank is responsible for making sure that that stays the case. All right. Central bank is also responsible for the issuance of legal tender. They're the only institution in the country, obviously, that issues Bahamian currency. All right. And whether that current currency is the physical bills that we see now that we get from commercial banks, central bank, in fact, have given, not given, distributed the currency to the commercial banks. The commercial banks, in turn, distributed to the general public. But the same thing applies to the now digital currency, the sand dollar. Central bank is responsible for issuing that as well. And again, and in this case, the central bank is able to tell commercial banks and whomever else that you cannot charge Bahamian dollars for Bahamians. You can't charge them for sand dollars. Just like how you can't charge Bahamians for physical currency. Because as far as the central bank is concerned, it's the exact same thing. It's just one is paper and one is electronic, but it's same Bahamian money, and you're not allowed. You know, this is completely different from if you're providing some service to Bahamians and you imposing a price on it. This is a different story. This is central bank money. We're the issue of legal tender, and whether that legal tender is physical or electronic, We have absolute control over that, and there's no way we're going to allow anybody to impose a charge on Bahamians for the use of Bahamian currency. Central bank also act as a banker to both domestic banks and the government. I think we mentioned it previously, just like how you have a bank account with your commercial bank, the commercial bank have a bank account with central bank, just like how you can borrow from your commercial bank can borrow from the central bank, and the same applies to government. Except that the government traditionally, even before there was a central bank, did most of its routine banking through the Royal Bank of Canada, RBC Royal Bank. And the central bank has authorized RBC to continue to perform that function as long as the government is happy with them. But if at any point in time the government is not happy with its relationship with RBC Royal Bank, the central bank is prepared to step in and perform the functions that are currently being performed by RBC Royal Bank. What else? The central bank obviously is the regulator and supervisor of the banking sector. Right? That's the commercial banks as well as the international banks and trust companies. Central bank is now the regulator and supervisor of the cooperative sector, that is the credit unions. Right? The previous Cooperative Credit Union Act was repealed, and a new act was enacted in 2015. And one of the things this new act did is they brought credit unions under the authority of the central bank. So now the central bank is responsible for overseeing credit unions and really treating them the same way they treat commercial banks. It has made for considerable adjustments by the credit unions in terms of their operations and their oversight, and it's been, an adjustment because the central bank's oversight system is much more stringent than what was previously the credit unions had to deal with. Also, the central bank has mandated that a lot of small credit unions had to be consolidated. So it's been an adjustment. In addition, the central bank is the regulator and supervisor of the National Credit Reporting System. All right, that is the Credit Bureau. The act itself was passed in 2018. The Credit Bureau was not licensed until 2020, and they have been busy now collecting information on me, you, and everyone else, and putting together these credit reports that is going to form the basis of all credit issuers when they assess us for facilities. But the Credit Bureau is both licensed, regulated, and supervised by the central bank. In addition, the central bank is now the regulator and supervisor of the retail payments sector. Retail payment service providers would be your Canoe, your Island Pay. Who else would be in that? I think there's a couple more that whose name I can't remember at the moment. But also includes your money transmission businesses operating in the Bahamas. So that will be your Omni, who else? Other names escape me, but you get the idea. So now the Central Bank Act 2000 and subsequent amendment, and then the new act in 2020 now added all these areas for central bank's direct supervision, where the central bank was not allowed to, under the previous act, to deal with any of these sectors, because if it wasn't specifically contained in the act, the central bank couldn't do it. Okay, so that is the functions and objectives of the central bank, but our interest really is in policy. How does the central bank conduct monetary policy what is the mechanism, and what is the central bank looking to achieve in terms of monetary policy? So if we're saying that central bank is responsible for safeguarding the Bahamian dollar, from a policy perspective, how do they actually do that? All right. So if we're going to talk about monetary policy, we need to start talking, first of all, about the bank's Monetary Policy Committee, the MPC. Most central banks all over the world have an MPC, a policy-making body of this type. In the United States, this is called the Federal Open Market Committee, the FOMC, because the Americans insist upon having their own nomenclature. Everywhere else in the world is called the MPC, the Monetary Policy Committee. And the MPC is the primary monetary policy body of the bank. All right. The Monetary Policy Committee assesses the conditions of the financial sector as well as the broader macroeconomy, and enacts policy using monetary policy tools to affect all aspects of the economy. All right. So you have this committee, the biggest, baddest committee in the central bank. They're the ones who make the pronouncement that changes the way our economy operates. All right. So in terms of the makeup of this committee, the MPC meets on a monthly basis. It's chaired by the governor, and membership includes the deputy governor, the heads of what we call functional departments. So functional departments are departments of the bank whose functions are involved in carrying out monetary policy. So it would be somebody like, say, the research department, who provides sort of the research effort. They produce the policy options that the committee would consider. You have your bank supervision department, who of course will implement any policy that relates to all of our licensees. You have the banking department and the currency department, who would effect any policy that relates to government finance, any open market operations by the bank, which we will talk about in a moment. All right. So, and then you have the exchange control department. So basically, you have the four heads of those functional departments. So you wouldn't have people on this committee like the head of the accounts department or the head of the human resources department. They wouldn't be on this committee. All right. This is a very high-level technical committee. All right. But the heads here, they're in essence there to take directions from the committee and then to effect the policy itself. So the heads of these departments are really, they're the ones who will then trickle down the activity to their colleagues, and that's how the work gets done. But in addition to governor, deputy governor, and the heads of these departments, most of the work of the committee is done by the technicians, people like me, whether talking to senior economists, the economists, economic advisors, and statisticians. And so these are the people who really form the technical arm of the committee. And this is almost entirely two departments are involved here. The research department, who provides the statistical data that the committee uses for analysis. Also, they provide the basic reports on what's going on in the economy. And then you have the governor's office, which is a department, although we call it the governor's office, and that includes advisors to the governor, senior economists like myself, and other economists. Okay, so that is the makeup of the committee. All right, so every month the committee meets, and they get all these reports from various departments and units within the bank, and also reports from outside the bank, and reports from places like Ministry of Finance and the Treasury. And they have high-level discussions. Occasionally, these evolve into arguments, but it gets very technical, and the kind of monetary policy stuff that the kind of macroeconomic stuff that we're talking about here, think of it raised to level 10 kind of thing. Right. And at the end of these meetings, within 5 days of each meeting, the bank publishes its analysis, a report coming out of the MPC that says, listen, we saw this, and this. This is our take on these things, this is our understanding of what's happening with the Bahamian economy. This is our understanding of what's happening in tourism. This is our understanding of what's happening in real estate, in construction, in banking, etc. And this is the policy decisions that the bank is implementing if it's changed from our last meeting. And then once every quarter, the committee would open itself up to the press. In essence, what happens is that the chairman, in this case, governor, would call in the press. For the last 2 years, it's all been virtual, of course. But eventually, we think sooner rather than later, it will go back to being in person. But for the moment, it's still virtual. And we would invite business journalists, Guardian, Tribune, ZNS, Cable, Bahamas Informational Services, Jones and Company, what's the other one? I can't remember the name of it. E-News, right? So they'll all be invited, and there'll be a press statement by the governor, which is a summary statement of coming out of the MPC. The full report is always published online, so they can see the full report if they wish. And they get to ask questions about economic questions, of course. Right. And that's the quarterly press briefing. And usually it ends up making news, et cetera, et cetera, et cetera. All right. So that's how the policy, the committee functions. Now, what about the tools that the committee actually uses? The monetary policy instruments, right? So we know, for example, we know what the committee wants to get done. The committee says we want to make sure the Bahamian economy stays 1-to-1. Right? That's job one. Once we've secured that, then we want to see what we can do to make sure the Bahamian economy grows. So first, our first task is to make sure the currency stays fixed at 1-to-1, because that is written into our act and we have no choice about it. Secondly, we want to make sure the economy grows. Now, if we have to choose between making sure the currency stays fixed at 1-to-1 and the economy growing, we're going to pick currency stays fixed to 1-to-1, even if that means the economy declines, falls, whatever. High unemployment, high inflation, whatever, as long as the exchange rate stays fixed at 1-to-1, that is job one of the bank. All right, so the committee focuses on that first, and then everything else comes after that. How do they operate? One of the first tools available to the committee is called the reserve requirement. We talked about it last class. We use it to calculate the money multiplier. All right. They're by law deposit money banks, which in our case is commercial banks. But since the central bank has now taken over regulations and supervision of credit unions, we've now brought them under the same statute. So we're now considering them deposit-taking institutions. Right. I know the credit unions call it, shares or whatever. But as far as central bank is concerned, if you're giving money to this organization, they're holding onto your money, they're paying you interest, that's a deposit-taking institution. So by law, these institutions are obliged to hold a specified proportion of their deposits in cash or near cash assets. All right. And this is called the reserve requirement. banks are prohibited from using such reserves to extend loans to customers. Right? If the central bank would increase this requirement, the amount of loans that banks are able to, if central bank would increase this requirement, that would limit the amount of loans that a bank is able to extend to its clients, right? Whereas a reduction in the reserve requirements would give banks more funds available for lending. Right? This is the stuff we talked about last time. This is fairly straightforward. Last class, we were using the whole 10. Oh, my apologies. We're using the whole 10%. Yeah. Just as a handy reference for our reserve requirements. All right. So, but central bank has absolute control over this reserve, this statutory reserve, and through the reserve requirement. All right. Now, in fact, the reserve requirement, we can now break that out into its two portions. One is the primary reserve, all right, or also referred to as the statutory reserve. That's the one that we're most familiar with. All right. And for the Bahamas, that is 5%. And that's been 5% since day one, and it has never changed. Although the bank has the authority to increase that to as high as 20%, it started at 5% and stayed at 5%. So 5% of all deposits, the commercial bank are required to hang on to so they can lend out the other 95%. And one of the reasons why, if you're wondering why it has never changed in the I don't know how many years, this is what, from 1974, this is what, 19 years, 18 years? Let me restate that, 48 years, sorry, is because the statutory reserve requirement is a very, very, very powerful tool. All right. This is like, I don't know, it's like using a cannon to try drive in a nail. It's just, it's overkill. I'll show you what I mean. All right, so it's 5%. The statutory reserve is 5%. Here, and I hope you can see this. This is our money supply. And in fact, we've seen this table previously. Let's see if I go back to it. Here. But this goes back to 2019. So I thought what I'll do, I will get the most up-to-date version of this table so you can see the full table currently as of June 2022. All right. And you find, and if you look at as of June 2022, money supply, the broad money M2, which really encompasses all of our deposits. So M2, we said, includes all our payment, all fixed deposits, savings deposit, and demand deposits.
Sorry, we can't see that. It's kind of small because of it's taking up the entire slide probably. Or it's in PDF.
Yeah.
You can't crop it or snapshot it.
I don't know. You actually do all these strange things.
Oh, sorry. Can you?
Okay. Oh no. I can work something out. Let me stop sharing that, and let me go to. Come on. Oops. Let's see. I can do. Hang on. I can do this. Call central bank. Okay. All right, so let's see, where are you guys? That's you guys there. Let me share my screen, and I want to share this. Okay, so you should be able to see my Google screen and the central bank's website. All right. Quarterly Statistical Digest, which is the data production. August 2022, which is what we're looking at. All right, and that's table 2.7, if I remember correctly. Okay, here we are. And let me make this bigger. All right, is that better?
Way better, thanks.
I can't see anything. It's black.
You can't see anything?
Oh, I don't know. I could have seen the first one, but I can't see this one.
Okay, let me stop share and let me try it again. Share screen, and I want this. Still nothing?
It's loading. Did you get this from Central Bank's website? Like,
Yes.
okay, I'll just look at it when class is done.
Okay, but all right. Let's see if I can synthesize this relatively straightforward. All right, our money supply M2, which we know it consists of all of our fixed deposits, Bahamian dollar fixed deposits, Bahamian dollar savings deposits, right, and demand deposits, right, plus some currency in active circulation, some cash that we have on hand. Together, they total $7.8 billion. Right? If you ignore if you take out the 400 million in active circulation, so you still have over $7.3 billion in deposits. All right. So $7.3 billion is what banks have available to lend out should they choose to do so. Right. 5% of that is what? $380 million. Right. So banks have to hang on to currently, banks have to hang on to $380 million that they can't lend out. All right. So that is supposed to cover when people come in to withdraw money off their accounts. Let's say if the central bank was to increase that to 10%, that's over $600 million that the banks cannot lend out. Okay. That's why the required reserve requirement hasn't been used, because it's such a powerful tool, and it's because it's such a powerful tool because the money supply is so large. So even a small change in the reserve requirement will have a huge impact on the amount of money that's available to lend out, or that has been constrained from the banks not being able to lend out the money. Right. So that's one of the reasons why, despite the fact that it is a tool, technically speaking, it has never been used, and it's unlikely, but technically it's still available to the central bank. And the reason why it's kept as an instrument that's available to the central bank, let me go back to the thingy, is that you would like to have, if there's the worst case conditions would happen in your economy, you want to have a tool that is big and strong and powerful enough to address such an event should it occur. All right, so we don't expect something to happen, but it's nice to have that big bad cannon should you need to use it. All right, so we have the statutory reserves, all right, which consists of the primary reserve. But there's also a reserve requirement called a secondary reserve. Right? And generally, we tend to refer to this as the liquid asset ratio, or LAR. If you are working in a bank where you're doing any reporting to the central bank, this would be something that's very familiar to you. But what the LAR does is it's an average of the reserve requirement, but differs depending on the types of deposit. So where the statutory reserve says 5% of all deposits, the secondary reserve says, okay, 20% of demand deposits you must hold. Demand deposits, because people use demand deposits all the time, so they're always withdrawing money from their demand deposit accounts. Right, 15% of savings and fixed deposits, because we don't think that happens often, and 15% of borrowings where a bank borrows money from the central bank or borrows money from another bank. So if you're a bank, you can certainly borrow money from another bank and then use that money to lend out to your clients. Right. And again, the liquid asset ratio imposes a reserve requirement on these various categories of deposits. Right. The interesting thing about the LAR liquid asset ratio is that although central bank says you have to hold on to 20% of demand deposits, 15% of savings and fixed deposits, and 15% of money that you borrow from other banks or borrow from the central bank, you don't have to hold on to that as cash. All right. The central bank says you can use government securities in place of cash. You can use your government securities to satisfy that requirement. Right? This is valuable for the banks because banks never want to hold on to cash. All right? Cash loses money for the bank. Right? Because if you have cash sitting in your vault, it's not making any money for you. The only time things are making money for you is if you can lend that out. Right. And it doesn't make sense you shipping that cash to the central bank to deposit on your account with the central bank, because as we've said previously, central bank is not paying any interest. And in fact, central bank charges you for maintaining those accounts. Right. So ideally, you want to hold as little cash as possible if you're a commercial bank. But yet you still have to satisfy these reserve requirements that's being imposed on you by the central bank. Right? So the central bank says, okay, if you buy treasury bills, government registered stock, Bahamas government stock, or Bahamas Mortgage Corp bonds, we are willing to accept that as meeting your LAR requirements. So let's say your LAR requirements, 20% of your demand deposits works out to $30 million. Well, you said, okay, I have $30 million in registered stock. Why did you hold this for me as opposed to me giving you $30 million in cash? All right. The bank, the commercial bank still earns interest on those bonds, right? So they, in essence, make money. Whether they have purchased treasury bills or BGRS or BGS or BMC, right, they earn interest. Whereas if they just keep that money in cash, they don't make any money off it. So they get to meet their central bank requirements, plus they get to make a little bit of money from these securities. All right, so the first instrument that's available to the central bank is they can adjust the reserve requirements. They don't do so, particularly the statutory reserve, this first one, but the bank has from time to time adjusted the secondary reserve requirement, the LAR ratio. Right. What else is available to the bank, to the MPC? They can adjust the discount rate. The discount rate in some jurisdictions is called a bank rate, but it is what the central bank would charge commercial banks who want to borrow money from the central bank. All right. So the discount rate is the rate that central bank would charge commercial banks who want to borrow money, should they choose to borrow money from the central bank. Now, there's a clear understanding, not law, but a clear understanding between the central bank and the commercial banks that if I make it cheaper for you to borrow money from me, even if you don't take me up on it, if I reduce the discount rate, which will make it cheaper if you wish to borrow money from me, I expect you to pass that on to your customers. So if I make it cheaper for you to borrow from me, I expect for you to make it cheaper for your customers to borrow from you. All right. That's why you see when the central bank changes the discount rate, banks change their prime rate. Right? It's gotten to the point where most Bahamians assume that the prime rate is set by the central bank, and it is not. The prime lending rate is set by the commercial banks themselves. All right, and let's define what we mean by the prime rate first. The prime rate is defined as the rate that commercial banks would offer their best corporate customers. All right, so let's say you are Scotiabank and you have as one of your customers Atlantis Resorts. All right, if Atlantis Resorts come to you and they want to borrow $100 million, this is the rate that you would charge them. Me and you are never going to get this rate. All right, but banks use this rate to benchmark all their other rates. So your mortgage rate will be prime plus something, prime plus 1%, prime plus 2%, etc. All right. Even your car loan rate or credit card rates are all, whether you see it or not, they're based on prime. All right. And the prime rate itself is based on the central bank's discount rate. So when central bank adjusts the discount rate, banks adjust their prime lending rate. Now, it's important to note that they are not obligated to do so. Right? There's no regulation or law that says that the commercial banks have to change their prime lending rate when central bank changes their rates. But they always do. Because think about this. Let's say central bank reduces its discount rate. Right? This is something that's going to make the news. All right. And the news are going to reflect the fact that they expect the prime rate to change accordingly. And let's say you are, let's call a bank. Let's say you're Commonwealth Bank. All right. And you decide, you know what? No. All right. Anybody say I have to, and I can do it. So now, what's going to happen to all the people who have loans at Commonwealth Bank? And they see other banks are dropping their rates because central bank adjusted the discount rate and the banks changed their prime rates. Commonwealth Bank's customers are going to be, to use the term, pissed. All right. Commonwealth Bank would never put themselves into a competitive disadvantage like that. So they're going to adjust at the same time. All right. Most banks' mortgages are tied explicitly to prime. So when the discount rate changes, the prime rate changes. When the prime rate changes, you expect the mortgage rate to change. All right, which usually means, as far as as Bahamians are concerned, all we're interested in is what happened to my monthly payment. So if that means my monthly payment is going to go down, I want to see that change yesterday. All right, and generally, what would happen is the banks will give customers the option. All right, they said we can change your monthly payments now. All right. Or you can maintain the same payment, but in fact, your loan would be shortened by maybe a couple of weeks, maybe a month, because of the lower interest rate. But the idea here is that central bank will use the discount rate as a policy tool. And that is, central bank said, well, yeah, if I change my discount rate, I know banks are going to change their prime rate, and that's going to affect the amount of money and credit that's flowing through the system. But here's the problem. Just because the central bank changes its discount rate, which is the rate that commercial banks can borrow from the central bank, commercial banks almost never borrow money from the central bank. All right? Almost never. Because there is only two reasons why a commercial bank would want or need to borrow money from the central bank. The first reason is that business is going really good for you as a bank, right? You have a lot of good customers, that is potential borrowers who you consider valuable. That is, I can lend them money and they can pay me back. All right, so these are my good customers, my grade A customers, however you're defining them. And I got a lot of them coming in. I'm ready to make facilities, but I'm running out of money to lend out. All right. So I would like to go to the central bank where I could borrow money from the central bank at, say, 3%, 2%, and turn around and make loans at 5, 6, 10, 12%. All right. That is a good business for me. I borrow money from the central bank at a low interest rate and make loans at high interest rates, and I make big bank. Right. So one reason why you'd want to borrow money from the central bank is, you have a lot of potential borrowers which exceeds the amount of money you have available. So you go to central banks and borrow extra from the central bank. The other possibility of why you would borrow money from the central bank is things are pretty sucky. All right. You have a lot of people coming in, drawing money off their accounts, all right, whether it's a savings account, demand deposits, or fixed deposits, people coming in and withdrawing money off their accounts, and you are running out of money to give to these people. Because the last thing you want as a bank for a Bahamian to say, I want to take money off my bank account, and you tell them you can't help them. All right. You have to come back tomorrow. All right. You know what can happen. All right. We can tell any and everybody we know about this lousy bank, and I want my money. And now all of a sudden, now you have all your customers coming in that they want to make sure they want to get their money now, because they don't want to be the one getting left holding the bag if something buck up and go wrong, and they can't get their money. All right. So you would want to borrow from the central bank if things are going really, really good for you, or you would want to borrow from the central bank if things are not going so well for you at all. The problem is the market and the general public will not be able to tell the difference. All they know is that you borrow from the central bank. They can't, because they ain't in your business, they don't know whether you borrow from central bank because things are going really, really good or things are going really, really bad. But human nature being what it is, we're going to assume the worst. Or if you don't say it's human nature, call it, prudence. All right. If I even think that my bank may be having some kind of issue, listen, give my money. Better safe than sorry. All right. So how would this information get out? Right. It's going to start from people with big money in the bank. Right. They're the ones who are going to most be in a position to know that their bank has gone to the central bank for money. Right. If you got a couple $100,000 in the bank, you can know if the bank is going to try and borrow money from the central bank, even if you don't know why. Right. So now you decide, listen, I'm going to move my money. And if here's somebody with only a couple of 10,000 in the bank, and they see somebody with 100,000, hundreds of thousands in the bank moving their money, then brother man, I can move my money too. And then the man will need a couple of thousand, he can move his money. And the problem is that we're not going to just do that. We're going to tell other people to do that too. The result will be what's called a run on the bank. And now what may not have been a problem for the bank is now a problem for the bank. Right? And because of this, commercial banks almost never borrow money from the central bank. Right? They will borrow money from each other first, before they come to the central bank to borrow money. So when central bank changes the discount rate, right, central bank knows that this acts as an indicator rate to commercial banks. All right. This is telling the commercial banks and through them the general public and the media that this is what central bank is thinking. This is direction central bank is trying to push the economy. Right. So the discount rate acts as an indicator rate because it is very rarely used as an actual tool for borrowings from the central bank. All right. The next instrument that central bank uses more often than you may think is called selective credit controls. Under its legislative mandate, the central bank, certainly the central bank of the Bahamas, has absolute authority, total and complete authority in regard to credit in the Bahamas. Right? Loans, any kind of lending facility. If a commercial bank or credit union is involved in issuing credit to Bahamians, central bank has absolute authority to tell, to mandate the total amount of credit issued by all commercial banks together. Central bank can control the amount of credit issued by any individual bank. It can adjust the terms and conditions of any and all credit products. It can determine down payments requirements, what any interest rate, and the length of time to any facility. Central bank can say what credit instruments banks are able to use or not use or make available or not make available, whether you're talking the system as a whole or individual commercial banks. Right. So the central bank has absolute authority over credit. And generally, the most dramatic example of this was after 9/11. I'm sure we remember it is when some fools flew some planes into some buildings in the United States, in New York and DC. And thereafter, Americans were terrified to fly. Right. The concern for us in the Bahamas and the central bank specifically was, again, the one-to-one exchange rate. That's what central bank worries about first of all. Right? And the one-to-one exchange rate only lasts as long as there's sufficient US dollars for Bahamian individuals, Bahamian companies, and Bahamian government to do whatever they want to do with US dollars. And if you would, I'm sure you noticed that we import almost everything that we consume in the Bahamas, right? So we always need US dollars, always need a ton of US dollars. We do have a international reserve account, right? Which basically is our US dollar account managed by the central bank. So central bank is in control of all the US dollars in the country. And by law, Bahamians are not supposed to hang on to US dollars. You're supposed to deposit that into the banks, and then the bank can't hang on to it. Banks are supposed to send it to the central bank. But the central bank has traditionally been very lax in that regard. But bottom line is that as long as we have enough US dollars to do everything that we need, Bahamians don't worry about it, right? But central bank does worry about it. And the reason why we're able to stay fixed at one-to-one, the exchange rate, is that we've always had a lot of US dollars coming into the country, either from tourism or by foreign investment. Right. After 9/11, no more tourists, no more foreign investment. And the central bank was very concerned. I sat in on a number of meetings at the time with the Monetary Policy Committee. What are we supposed to do if Americans stop coming from the Bahamas to the Bahamas for any extended period of time? Because at the time we had international reserves. This is the US dollars in our national bank account, if you will, enough to last the Bahamas maybe 4 months. So if not a single US dollar came in, we had enough US dollars in the kitty to keep the country going for about 4 months. Right? But what if Americans stayed away? Right. So the committee was faced with an issue. Right. We have no control over the amount of US dollars coming into the country, how much or if Americans would ever come back again. So if you have no control of the amount of money coming in, then by damn, you need to control the amount of money going out. All right. Now, we in the Bahamas, all of our largest expenditures are all borrowed money. House, car, furniture, appliances, for people travel, tuition, you know, most of our biggest expenditures are borrowed money. And that money almost inevitably goes out of the Bahamas in one way or another. Right? So we know, or if we're still talking about the committee at this time, the committee knew that when Bahamians borrow money from the bank, that is going to cause the US dollar bank account, the international reserves, to be depleted, because that money inevitably is going to go out of the country. The only way to stop this process is to stop Bahamians from borrowing. Right? So using selective credit controls, the central bank and the governor at that time called in the heads of all the banks. Emergency meeting. All right. And the Monetary Policy Committee, through the governor, issued the edict to the commercial banks that you cannot offer not $1 in initial loans, credit of any kind, right, beyond what you have on record as at this date. Now, if people come in and pay off or pay down on any facility, you can use that money, but you can't offer any new money. So if you are RBC Royal Bank and you have, say, $700 million in credit facilities and loans out there, right? You could not exceed that total amount of 700 million until central bank says otherwise. And to enforce this law, central bank required the commercial banks to report to the central bank on a daily basis with their total amount of facilities that they had out there, daily basis. And the central bank threatened the banks with imposing a fine of $50,000 per day should they decide to test the central bank in this regard. All right. Absolute credit control. And in fact, central bank maintained that policy for 18 months, even though the impact in terms of Americans flying only lasted maybe 3-4 months. This was in September. By the Christmas season, Americans were coming back to the Bahamas. But the bank was so concerned that in the interim between September and December, we had drawn down on our stock of US dollars. Because remember now, regardless of whether tourists come or not, we still got to buy food for Bahamians to consume. And you know, we don't grow enough to feed ourselves. So there is some amount of US dollars that had to be spent regardless. Right. So what happened is that central bank says we're going to maintain the policy until we get back to where we think we need to be. Right. So it took as 18 months before the central bank says, okay, fine, we feel comfortable enough that we will remove the policy. And when they removed the policy, we saw a huge spike in loans issued by commercial banks because they couldn't wait, and Bahamians couldn't wait because for a year and a half, nobody could borrow. Right? Absolute credit controls. Right? Again, central bank doesn't expect to have to do something that drastic unless things are really warranted. Right? But they certainly have the tools available to them. And let's see, where are we? The tool most often used by the central bank is actually moral suasion. And moral suasion is getting people to do what you want them to do without actually changing a policy. So moral suasion is generally regarded as a process where commercial banks cooperate with the central bank, either because it's in their best interest for altruistic reason, or because they're really scared of what central bank might do if they don't toe the line, or out of fear of administrative or legislative sanctions. Because remember now, the central bank is one who is issuing your license, right? And your license is renewed every year. In addition, central bank is the ones who do the inspection. Yeah, so it's very possible for them, instead of coming in and disrupting your operation every other year, they decide they want to do it every year, every 6 months, every 3 months, to the point where it is very hard for you to get anything done because central bank is imposing so much regulatory, onerous regulations on top of your head. You know what? It ain't worth it. Let's just, okay, fine, whatever. Now, how does this work in reality? Well, the central bank governor has a monthly meeting with all the heads every month. For last years, it's been virtual, but prior to that, it's been in person. And the meetings usually held at the central bank when it's in person. Going back maybe 5-10 years ago, a decade ago, it used to be held at some fancy swank restaurant, but now it's all held central bank's boardroom. Right? So the heads will come to the central bank. Usually it's on a Friday morning, sorry, on a Thursday morning. Sit around a conference table in the boardroom, have coffee and drinks and Danishes and sweets or whatever, and they would have a little chat. All right. And the central bank governor will normally talk about what's going on in the economy, what's going on in the bank, economic and financial developments, and the heads are trying to hear what he's not saying. All right. So if he's talking about some issue with banking practices and some concern that's been brought to his attention, or some policy that the bank is considering, the heads are hearing, what does this mean for my institution? All right, because what you would like to do as a commercial bank, all right, you would like to be able to make the adjustments on your own time, within your own facility, as opposed to having this imposed on you from the central bank. Then you don't have any choice of how you make this done. So let's say the central bank has indicated that there is some concern about the quality of lenders, and central bank is concerned there's an increase in delinquencies, and it's concerned to the point where the matter has been referred to the inspector of banks and trust companies. The inspector is, in essence, bank police. All right, they're the ones who, if you work in your head office, the inspector is the one you're most concerned about You're not concerned about the governor. Yeah. But the inspector is the one who's on the ground, likely to impose the fines, likely to change policies that affect the way you do your business, right? So if that's the case, then the heads, when they go back to their head office, they're going to make appropriate phone calls to people within their institution to ensure, first of all, that he's not talking about us. And secondly, if he might be talking to us, talking about us, what adjustments can we make in terms of our own systems and processes so that it doesn't get to the point where, I get a letter from the inspector saying that, he's sending an inspection team over. Right. That is called moral suasion. You getting institutions to make adjustments without having to change policy. Right. Now, this may not happen in just at one specific monthly meeting. This may be it may be a series of meetings before what the governor's trying to make clear to the banks, to the heads, they pick up on and decide, okay, well, maybe I need to make some changes. Right. And finally, open market operations. Right, the final instrument that the central bank through its monetary policy committee can implement is called open market operations. And open market operations occurs when the central bank buys government securities or sells government securities to the commercial banks in order to affect the total amount of loanable funds or liquidity that banks have available. Right. They do this in two ways. The first is what we call expansionary monetary policy. Right. So let's assume for a moment that the central bank wishes to grow the economy, and they don't see this as being a threat to the exchange rate. So once they've decided that we can grow the economy without necessarily threatening the exchange rate, okay, growing the economy means causing GDP to expand. All right. This is called expansionary fiscal policy, where the central bank is trying to grow the economy. The way the central bank would do this, they would achieve this by buying government securities from the commercial banks. So the central bank will send a note to the commercial bank, says, I would like to buy some government securities from you, some registered stock or some BGS. Now, again, commercial banks are not obligated to sell these securities to the central bank, but for reasons that we've already talked about, more than likely they're going to cooperate with the central bank, and they're going to sell these securities to the central bank. So the central bank will buy government securities from the commercial banks and credit their accounts with the money. Right? Because all of them have bank accounts with the central bank will buy the securities from them and credit their accounts with the money. Now, the commercial banks have all this extra money sitting in their bank account with the central bank. Well, remember now, they're making no interest off this. So it makes sense then, as far as they're concerned, I need to try and put that money to use. And the way the banks would put that liquidity to use is by making loans. All right. That is, they're going to, this will cause the interest rate to go down, which makes an increase in demand for loans, because if interest rates are going down, it makes persons who previously couldn't qualify for loans would now qualify, and people who could qualify previously may now qualify for even more. Right. So as interest rates go down, there's an increase in demand for loans. As we talked about previously, people don't borrow money from the bank just to turn around and put it back in the bank as deposits. They borrow money from the bank to spend. So they purchase goods and services, which we know causes the aggregate demand or GDP to go up. So if central bank is looking to grow the economy, they can use open market operations. They can buy government securities from the commercial banks, and credit commercial banks with the money. Now, commercial banks will have this money to lend out. That causes interest rates to go down. More loans are issued. More loans means more purchase of goods and services. causes aggregate demand or GDP to go up. The economy goes up. On the other hand, the central bank can act to slow down the growth of the economy. All right. So let's say, for whatever reason, central bank is saying the economy is growing too fast, people are borrowing too much, that's causing pressure on the stock of international reserves, which gives us concern about what that may mean for the fixed exchange rate regime. So central bank is going to focus first of all on the exchange rate, and they're going to worry about that one-to-one parity. All right. So let's say central bank is concerned about one-to-one parity, and they said, then they decide, the Monetary Policy Committee decides we need to slow this puppy down. Yeah. Now, obviously, politicians don't like that, so the government is going to be not very happy about it, because as long as the party going, yeah, everybody happy, everybody making money, they figure we can get reelected. Central bank don't care about none of that. All central banks care about says, you know, our legislation says we have to make sure that the Bahamian dollar says fix a one-to-one. You know, politicians, that's your all issues. We're gonna make sure stay. So if that means we get to slow down the economy, well, you know, party done. So central bank wishes to slow down the growth of the economy. All right. So they want GDP, change in GDP to slow or even contract. So this is called contractionary monetary policy. Central bank is trying to slow things down. The way central bank would do this says they will sell government securities to commercial banks. Now, central bank said, I want to sell some government securities. Now, you're not obligated to buy these government securities from me. Yeah, but you do got a licensing issue coming up, you know. Yeah. So commercial banks buy these government securities from the central bank, and they use the money from their bank accounts with the central bank to pay for these securities. So if they're using the money out of their account, their bank account, the central bank to pay for these securities, then that money is no longer available for them to make loans. In this way, commercial banks have less liquidity with which to make loans. All right. So now people who previously would qualify won't be qualifying anymore. And even people who did qualify would decide that I don't need to borrow as much because of these higher interest rates. The result is a fall off in demand for loans and a decline in the purchase of goods and services. Aggregate demand falls. That's called contractionary monetary policy using open market operations. And then lastly, right, two other tools that are very rarely used, and I can only remember one time being used in the Bahamas, repos, which is repurchase agreements, and quantitative easing, or QE. A repurchase agreement, or repo, is a contract between the central bank and an individual commercial bank, right, which allows the commercial bank to sell government securities to the central bank to meet its statutory obligation. All right. Remember we said both the statutory reserve and the secondary reserve, or LAR ratio. These are central bank requirements that says, listen, you have to hold on to a certain amount of liquidity just in case people want to take money off their accounts. Right? Now, if you are a commercial bank, right, and you find yourself in the position that you have to meet this requirement 5 o'clock every day, and you see come 4 o'clock and you just don't have enough money to meet this requirement, right? You don't have enough cash to meet this requirement, but you have some government securities. You have some BGS, BGRS, or you have some Bahamas Mortgage Corp bonds, right? And if we're talking about your statutory requirements, Right? Those bonds in and of themselves cannot meet your statutory requirements. Now they can meet your LAR ratio, but they can't meet your statutory requirements. So you're in a pickle. You know you have to meet your statutory requirements. Otherwise, you're going to incur some huge fine from the central bank. Right? The kinds of fine that has caused people to get fired. Right? So then you say, okay, why don't I sell these bonds to you, Mr. Central Bank, right? So that now you credit my account with sufficient cash to meet the requirements, the reserve requirements, statutory reserve requirements. Right? But I know I can have enough money come tomorrow. So why don't we do this? All right. I sell you this bond today, right? So that I can get the cash to meet my reserve requirement. But you agree to sell that back to me tomorrow, so that when I get this extra money coming in, I can get my bond back. And the reason why I want my bond back, because my bond pays me interest. Cash on my bank account with you doesn't pay me anything. So a repurchase agreement says that I agree with you, Mr. Central Bank, I will sell you this bond, so I get the cash to meet my statutory requirements, but come tomorrow, you agree to sell my bond back to me. Right. So repurchase agreements almost always are overnight transactions. Right. So allows the commercial bank to sell government securities to the central bank to meet its statutory obligation, with the explicit agreement that the central bank will resell securities. Okay, that's spelled wrong. Respell these securities back to the commercial bank, usually the following day. So this transaction normally is usually when you really run up against it, and it's an overnight transaction. You just don't have the money today, but you know you're gonna have the money tomorrow. So I can sell this bond to you today with the explicit understanding, contractual understanding, because it's a contract, that you're going to sell it back to me tomorrow. Banks also do this between themselves. All right. You are Scotiabank, and you know you coming up against your statutory requirement, and you running short. All right. So you call up what's the name at RBC Royal Bank, and you say, listen, Lasagna. Lasagna Missick is the managing director at RBC Royal Bank. I got it tough, and I got to make my central bank payment. That statutory requirement. How about I got some government bonds. I will sell this to you. I know you got some excess cash you don't do nothing with. Why don't you let me use that excess cash to meet my central bank requirement? Any issue hanging on that cash, because that ain't paying no interest. All right. At least the bond, you get 1 day interest. So I sell you the bond, but I want my bond back come tomorrow. Right? And you come up with an explicit agreement between commercial banks. Now, banks also lend money to each other without this kind of arrangement. But a repurchase agreement is a specific contract where you sell government securities in exchange, and you get to purchase it back the following day. All right. Like I said, I've only seen this happen one time in the Bahamas, but we expect the bank has put in the facilities to allow it to happen more often should commercial banks need to. And then we have what is called quantitative easing. This is not something that's occurred in the Bahamas, but again, it's something that's available to us should we wish to do so. A quantitative easing is a monetary policy where the central bank purchases predetermined amount of government bonds to force more liquidity into the hands of banks. All right. So central bank, we want the economy to grow. All right, which means we want to force banks to make more loans. Right. One way of doing that is like, listen, we want you commercial banks to buy $200 million worth of government securities. Now, they don't if, ands, or buts. We need you to buy $200 million worth of government securities. Right? We can take the money out your account. Right? Quantitative easing. It's unconventional form of monetary policy and is usually used when inflation is very low, unlike now, or negative, and when standard monetary policy instruments tools have become ineffective. We haven't arrived at a point in the Bahamas yet where either of those criteria has been met. Obviously, inflation is quite high in the Bahamas, well, high relatively speaking. And we still have many monetary policy instruments that are still quite effective. All right. So we haven't seen quantitative easing in the Bahamas, but certainly has occurred elsewhere in the world, including the UK and EU and the US, and certainly in Japan. But we have the facilities to do it should the Central Bank of the Bahamas choose to do so. And that, ladies and gentlemen, brings us to the end. And I'm happy to entertain any comments or questions you may have. According to my watch, I have 5 minutes before 8. I was aiming for 8 o'clock, and I'm glad to see I made it. Oh, no questions? Everybody gone? All right, fine. Stop sharing. Okay. If that's the case, I will send everybody these last set of notes so you have it available to you. And I'm proposing Monday. I'm thinking, why don't we do a mock final? Right. That is, I take an old final paper. Right. Because I haven't finished writing your final exam as yet. So why don't we take an old final paper and we walk our way through it, through the entire paper, so you get a feel for what your final exam would look like and feel like. Yeah. And I can send it to you ahead of time. I think that will be most useful, as opposed to trying to figure out what area I should review, or trying to talk which portion of the entire semester we should be reviewing. If you guys are in agreement.
That sounds excellent.
Yeah, I'm agreeing too. The question is though, Mr. Demerit, are we having any essay questions on the final exam, or this is just like a replica of what's to be expected?
I don't know yet. It's possible, but I don't know yet. I will know by Monday.
Okay, so you'll send it to us over the weekend.
Oh, no, I will send the mock final at some point this week. But in terms of the final exam, the format of the final exam, I won't know if I'm going to include an essay question in it yet. I suspect I will, but I don't want to say that for sure yet.
But you'll let us know by the end of Monday.
Monday, yes, by Monday.
All right, that's fine.
All right.
Yes.
Any other questions?
Will Monday be our last class, or?
Monday will be our last class. After that, you have until what did we agree? We agree on the 21st?
Yeah.
We agree on the 21st. What I will do is that I will send your final exam to the Institute, and they will, put on the lock and key, embargo it, whatever it is, until the 21st, and they will invigilate it. I won't be there. So you would have nobody to ask questions of during the course of the exam. Sorry.
Well, we'll have an opportunity to discuss what is to be covered on the final exam on Monday as well.
Yeah, the mock final will be because it's a previous final paper, so it will be as close to a final exam as you're likely to see before the 21st. All right.
Yes.
All right, folks, in that case, then I will bid you guys good night. Enjoy the rest of your week, and I will see you guys on Monday.
So,
All right. Good evening, everyone.
alrighty,
All right,
good evening.